let's start from the basics. What we started this lecture with is what is option, and we talked about that we are talking only about European options as of now. We technically talk about every option on options about options on all assets, but we do focus in examples or some tasks on options on FX. So we are talking about European FX options as an examples in this lecture, but the lecture covers basically European options on all assets. So what we started with is we already took some assumption that you're familiar with what is option itself, what are the basics of options, like what is a delta, what is gamma, or at least what is delta is, what is underlying, what are rates. This is actually quite important topic. So maybe some of you did have some difficulties because of, we usually in our examples, we do think about rates being zero. So that makes forward equal to spot. And that makes it easier to focus on other parts of the problem, excluding this effect that your spot is not equal to forward. That is easy. But in real world, it's almost never the case. At least it's never makes sense to assume this in a production grade code or tasks. So if you still have some, I would say, difficulties with understanding this, I highly recommend you to basically find literature about some swaps and forwards and futures. This will be perfectly enough for you. Some literature actually focuses on zero coupon bonds, so-called, but this is like just a convenient mathematical method. Anyway, just read about it. Nothing changes further on if there are rates, at least not much changes. So in some cases, I explicitly say that this, what I'm talking about, changes when forward is not equal to spot, or when we should focus that something is not equal forward or near the forward and so on. It will be especially important on later today when we are talking about volatility surface construction, about the money delta neutral and the money forward, what are the differences at the money spot. So here you cannot ignore that fact that forward is almost always not equal to spot. So those are prerequisites, right? We started our lectures with this, with those, and the first lecture was about delta and gamma. So let's think about it again. Some things, of course, are familiar for you, but keep your focus. I think there might be something new by accident. So every option has its delta. It's can be any way close to zero. That's true. So, but technically it's never zero. What we are talking here about is that if I have, let's say you have some call, and you have time equals time to expiry. So basically that means that at that exact moment you need to make a decision if you are, as a buyer of a call, if you're a buyer of a call, if you are executing the option. So call gives you an opportunity to buy. So you might want to take this opportunity and buy, and you might you might want to not take this opportunity and just leave it as it is. So don't make this purchase, right? So what is the delta here? It's quite understandable that if you have strike here at this point, everything which is below the strike doesn't make sense to buy. Everything which is above the strike does make sense to buy. So you buy asset and you have this delta because now you have this asset, right, that you bought. People do draw this line. Basically, it represents just some connection between those two lines. Mathematically, there is no such a line at this exact point here. At this point, either you buy, either or that was a mistake. Yeah, sorry. Yeah. So at this point, either you want to buy or you don't want to buy. It actually doesn't matter. You just want to make some decision beforehand. So if it's at the strike, am I buying or not? If you're trading on exchange will automatically execute you. And some exchanges do have some tricky rules. Like, for example, if your expiry at the strike, you exercise half for call and put, but I think it's round up for a call and round down for a put. So it's put on 3 futures. You'll have one future exercised, and if it's the same call, the same strike, you'll have 2. Though the sum will be 3. That's what you exactly want, right? If you have a synthetical forward, it will exercise perfectly correct. You can forget about this in 5 minutes. It doesn't matter that much. Just keep in mind that in this exact point, there is something that might need your attention. If you're doing some code or if you're trading on a real exchange, sometimes it doesn't matter at all, because one contract plus, one contract minus, no one cares about that. But on some exchanges, they don't do automatic execution. So they do automatic execution only if you're far away. Come on. If you're somewhere like here or here, they do automatic execution. And if you're somewhere in this area, so near the strike, what I would say, exchange won't do automatic execution, so you need to focus at that point and just click the button, whatever the button is, if you want to execute or not. Me personally, I traded on one of those venues and I lost like my 5 months salary. It's a good thing that my 5 months salary was a couple seconds income for a bank, so no one cared about that. But that lesson is much more cheaper here, right? So
excuse me.
Yeah.
I've just written a small question in the chat. Can you answer? Sorry.
Oh, sure. I didn't turn it on. Can you clarify, are you explaining how to open at a delta neutral position? Not yet. We are just, again, this lecture is an overview of the all lectures we had before. So we're going from the start to the last lecture, but just with a 10x speed. That's what we're doing here. I'm just adding up some flavors of something that I might not say. So some of you who did pay attention, like who focused on the lectures, don't feel themselves like they're watching the same film again, right? So again, this line, we will just we will just put it here. Next, we have this delta for a call option. How does it look like if it's time to expiry minus, say, 2 days? It can be seen easily that on the far ends, so here and here, it will be the same, because 2 days doesn't give you, like, it doesn't changes the probability of you being somewhere far away. Let's think about it a little bit deeper. Let's think that you have Eurodollar option and the strike is 120, spot is 120. So spot is price of underlying for maybe new people. Can I do it? Yeah, nice. That's okay. What if, and our delta is around 50% here. Why? It's just at the spot. So it's kind of 50%. You can be higher or lower at the end of this option. So at time equals to time to expire, right? So it's a 50-50. You'll have either 1 or 0, right? So your expectation, it's about 0.5, right? So half. So your delta is, it's around 0.5. It's a delta sign. That's okay. What if your spot is equals 1? Let's say you traded it when euro-dollar was 1, or at least like someone here. Easily can be seen that for euro-dollar to make 20% move in 2 days time, we're talking about time to expiry minus 2 days. It's almost impossible. I mean, now we live in a world when not that much is impossible, but still, it's. I would say most probably you won't see it in your lifetime. This happens. So delta is really close to 0. Because look, you have a strike of 0.2. Your spot is 1. You have 2 days to go. If you do some Monte Carlo or you do some exercise in your head, like what should happen for this strike to be in the money, so for this call, for spot to be higher or at least equal to 120, it's just impossible. I mean, like something like a nuclear war should happen, right? No politics here, but I mean, like this is impossible, right? So you think that your delta is equals 0 because you're too far away from the strike. So again, it's easily can be seen that the delta will be the same at the far ends, here and here. It will be the same. And it's also easily can be seen that delta is 0.5 at the center. So if spot equals strike, it will be 0.5 somewhere here. If you taking a look at, say, time to expiry minus 2 minutes, it can be seen that even here delta is like on the upper side it's 1 and on the lower side it's 0. So somewhere here it should be doing something like this. And the further we go, if time again, if we are taking a look at time equals minus 2 days, it will be just like here. Yeah. So delta will be equals to 1 and 0 further away from the strike. So those are delta profiles of a call option. Can be easily thought about, but if you're talking about put option, you just need to flip the chart on both axes, and you have your put option delta. It looks like really reasonable. Basically, that was a first half lecture. So next, what we're talking about here is gamma. This is the first interesting Greek, I would say. It's really important in real day trading. Gamma is just a derivative of delta by spot, so it's nothing rocket science here. No rocket science here. If we again draw some delta graph, or the same call option, it will be something like this. It can be seen that if you're talking about gamma, that your highest point is somewhere near the strike. It's where you can see the highest slope. So by slope, I mean this, right? So your highest point somewhere here. Your lowest points are on the far ends, because there the graph is basically 0 on the left hand and 1 on the right hand. And so you have zeros here. So you should have something like a bell curve graph, right? Just as a derivative, okay, so just as a derivative of the upper graph, yeah. The gamma looks like a bell curve. It can be also easily seen that if we are talking about, this is our graph for time to expiry, minus 2 days. If you're talking about time to expiry minus 2 minutes, the graph will be much closer, like this, and that will make this bell curve much more narrower, right? Yeah. So this part should be smaller. Makes sense? Because it's already seen here that the derivative is close to 0. So it will, at the first glance, again, I will draw something that can be not quite correct as we will see later. But it seems that it should be like this, right? Makes sense. Though, if you think about it, if we take space under the graph of gamma, should be equal the change in delta from this point to this point, because it's a derivative. And if you take a graph of derivative and take a space under it, we basically have a change in what we took a derivative of, right? So as it changes from, say, 0 to 1, all the graphs we are drawing here should have the same space under them. And if we know for sure that this, I'll take another color, say this one, and this graph, we do know that it goes to 0 faster than the white one, so it must be higher. Now it looks like, right? So, good question. First, we talked on the lectures about it, but not every call option goes to 1 at infinity. Some options do go to 0. I mean, call options. We are talking about call options. It depends on your base currency, numerary currency. We won't focus on this here. What I did expect is to someone to tell me that if it goes to 0, then it should be that the space under the gamma graph should be also 0. So that question was not asked on these lectures. You can think about it yourself and give me an answer next lecture. But we will focus today only on graphs that goes to 0 on the right-hand side for delta of a call option. That's because basically this is a academic approach and we don't have that much time. So I just want to refresh the whole logic of the course, not the details itself, exactly. So again, if you think about it, if we are talking about derivative of this, a vertical line, it gives us some strange graph for gamma. Basically, it's a vertical line. If you are talking about gamma profile at the time of expiry, your gamma looks like a vertical line that has technically no value can be assigned to it despite of infinite, though it's integral has some value. It's basically 1. There are such mathematical functions. A good way to think about it, if you don't want to think about this mathematical paradox or whatever you think it is just not to think about gamma at the times that are close to expiry. In real world scenarios, the gamma is calculated up until some time to expiry. Say in most banks, time to expiry minus 1 day is basically last time you calculate your gamma. After that, you just don't calculate gamma of an option, and you think about its delta as if it's for a call, if the spot is higher than the strike, the delta is 1, and if spot is lower than the strike, delta is 0, and vice versa for the put. Sure. So basically, it's like it goes to manual. Like before that, system gives you some numbers for gamma for you to hedge, and after that, it just goes to manual. You manually hedge your delta as you want. So system doesn't calculate this. It's a different approach in mathematical systems, and there are different approaches to do that. Some mathematical systems, they actually prefer not to trade those close options. So it's something to think about. Again, if you're working with options, it's something to think about how you want to calculate and hedge your gamma when some option goes to expiry. So it's like 2 minutes, 1 second before expiry, and it's at the strike. You just might want to think about it. That was basically first 2 Greeks. Again, some new flavor for you. Let's say, do you think that if there can be a situation where you have a call option with strike equals, say, I don't know, let's say you're trading some currency and you have strike equals 75, and your spot is higher than the strike. No, let it be easier to explain. So your spot is easier, it's lower than the strike. Do you think there is a possibility the buyer of this option will exercise the option? So again, we do think about options as call options. We're talking about call options at this particular example and last 2 examples also. We do think that delta equals 1 above the strike, because then we exercise the option. That's a nice assumption, actually, right? This is no more than an assumption. Are there possibilities for call option with the strike higher than the spot to be exercised? So what do you think? I'll give you like a minute. Sorry?
If there is only 1 day left and the spot is lower than the strike, I would exercise this call option, because in time of 1 day with a high probability, my value will turn into dust.
Your value is technically already dust, because strike is higher than the spot. Why would you buy with this option at 75 if spot is trading lower? You can buy on the market.
I mean, so I would exercise. If I would already have had this option and there is only 1 day left, I would, get rid of it.
You would get rid of this option?
Sure.
By exercising it?
Yes.
Okay. Maybe you think that spot is really lower than the strike, say like 674. I would say that it still doesn't make sense to get rid of any option, because the real market, it does have those fat tails you never know about, and you encounter them in your career like many times. Those tails are not that fat as you think, in terms of like they actually can be fat. I mean, they're not that rare, actually. They're not as rare as a normal distribution. I saw 10 standard deviation move in some asset that trades tens of billions per day. So it's super liquid asset. And there was a 10, or I think it was 7 standard deviations per day. So you don't want to do this really. If it's in your system, it's already marked at 0. So by doing this, you won't make money actually. What is it if it's about 74.98? What do you think now?
So can you hedge it? Because my understanding
you
for European options, you can exercise before the expiry date. You have to wait it before the expires, right?
That's actually a really interesting question. What is, like, we're talking about European options.
Yeah.
European option are exercised two ways. First, and the easiest one, is a fixing. So someone really reliable, so not your friend, calculates some fixing, some exchange or some or central bank, for example, right? And if the fixing is above your strike, it's exercised. If it's below, it's not. Again, we are talking about call options here, right? So that's the first way, and it's the easiest one. You don't decide actually nothing, because it's basically decided for you, right? But it's decided in your favor still. 99.9% of time, you do want to exercise call option if the fixing is higher. Though, there are second types of European options. Those are traded OTC. So those are traded bank with bank, or bank with the hedge fund, with the pension fund, whatever, like big institutions, big corporates, and so on. And for those European options, what do you have is a day of exercise. Say it will be 20th of July, so tomorrow, and time of exercise. Say it will be 10 a.m. London time. So how it works? Until 10.00 minutes and seconds, you have time to tell your counterparty if you exercise it or not on that day. You cannot do this day before. You cannot do this after 10 a.m. So at 10.01, you cannot do this. There was a couple of times in my career I was a little bit late for exercise, but those were not close. So once in my life, I was at a really close exercise. It was like, say, in terms of movement, it was like a 2-3 minutes move. So in 2-3 minutes, it could be above or below. So it was not that clear actually, but that went good. My counterparty told me like that he assumed that I would do this, and I actually wanted to do this. So I got lucky. It's not always like this. Several times counterparties did forget about this time, and once I exercised them not as they wanted. But again, so there is a gray area kind of. It's technically not gray. It's technically not gray. So until this time, you say your counterparty if you're exercising or not. That's it. It's gray in terms of you don't always tell if it's above or below for a reasonable amount. So everyone understands you won't do it. But sometimes some people do want to do it. Anyway, so we're talking about second part. So you have, let's say, until 10 a.m. AM London time. And now on the clock, it's 9:59, say 55. You see, you have a strike of 75 and the spot is 74.98. You are a buyer of a call with this strike. Do you think that there is a possibility for you as a reasonable human being, not as a fired trader five minutes ago by your boss, just a reasonable human being, not or to exercise this option? What do you think?
Can you repeat that again, please, Anton?
Sure. So in 5 seconds time, not you, but let's imagine you're a trader, and in 5 seconds time, you as a trader need to tell your counterparty if you want to exercise or you don't want to exercise this call option with the strike 75. Your spot is 74.98. you see that this underlying is trades at this exact time, at this second, at 74.98. Do you think there is a possibility, there is a case that you can imagine that you will exercise this call option?
So the strike is 75
Above.
and the spot is above, and the spot is 74.98.
Yeah.
So yeah, so it's very close. So and
Yep.
it's only 5 seconds left.
Yep.
Honestly, I
No.
don't know.
Let's say it's 1 second left. Let's say it's 1 second left. So
yeah.
technically, the probability of spot to trade higher, I would say 1 out of 100. So it's like really, really small. The probability of spot goes this two whatever this cents higher. Yeah, it's really, really small. It's below, but small margin below the strike. So what would you say if I would say that this trader exercised his call option? What would you assume? Why would you assume this trader do this?
So there's a possibility of this spot price will go up.
Yeah.
Less than.
I mean, if it's 1 out of 100, so the expected value is below 0 still, right?
Dividends?
Sorry?
Dividends?
No. Dividends are almost always paid overnight, so you don't see dividend gap during the day mostly. So no. Easier. Let's say you have a call option on $200 million. Say $500 million. Technically, if at that exact moment you need to buy, say $400 million or $450 or $550 or $650 million, so somewhere near this sum, either you can go on the market and try to buy them, and that most probably will move the spot higher. It will move the spot to say 74, 15, 20, 30, something like this. Yeah. So it might move higher. By exercising this option, which is out of the money, you can buy these $500 million at 75 and not buying them, moving the market higher and higher and higher. You see? The probability of this exact scenario is the probability that options trader sitting there, most probably he doesn't need to buy this $500 million at that exact moment. But usually they do sit near the spot trader who might have this need. So the spot trader, let's say, has some order to buy $1 billion of something, and there is a options trader. This probability is, I would say, spot trader to have this size of order at the fixing moment, say somewhere near exercise time, would be 1 out of 20, 30, something like this, like a 3% chance. And you have this option near the strike would be 1 out of, I would say, like a percent probability. So it gives you 3 or per 10,000. It looks small, but technically when you are trading, it can happen. In my experience, it happened like 3 or 4 times. The other question is, can you exercise partially? Can someone exercise a part of an option? What do you think? It's a European option. So you have right to buy, let's say, in this example, $500 million. Does it include right to buy, say, 250? What do you think?
There's a possibility, right?
No. I mean, like, what do you think? How the market functions? If you have a European option, when you read the book, it says that you have a right to buy $500 million. In the book, there won't be $500 million, but in the book, it says that you have a right to buy some asset. You're a buyer of a call option, right? I'm telling you, you bought a call option in notional of $500 million. What do you think? Can you buy not all of it? Can you buy 250?
But
Or
when you buy, the
300?
price will move, right?
No, you buy as exercising the call. Sorry, do you understand the question? What do you think? Or you have some doubts?
Can you elaborate again more?
Sure. So you're a buyer. You bought call option. So technically you are already long. Call option. Notional is $500 million. It gives you, if you're reading a book about European options, this position gives you opportunity to buy $500 million. At strike, say strike is, what was it here? 75. At 75, we do all agree about it. It's basically a definition of a call option, right? So do you think you have opportunity to buy not 500, buy 250? So I go to my counterparty who sold me this option and tell him, I want to exercise option, but not in notional $500 million, but 250. What do you say? Do you think it's possible? Or you must to buy or 500 or nothing?
So the question is, can you buy the whole thing 500 million, or you can buy half of it?
Yeah. What do you think?
I guess you can buy half. I'm just guessing. Yeah.
Yes, sure. Yeah, of course. I mean, like books, they don't elaborate on this if they're not like about some particular market. But on almost all markets, you can exercise just part of it. Just part. So that also happened a couple of times. So someone tells you he wants to exercise half usually, or a third, something like this. So that's also a possibility. This exact possibility actually increases probability of this to happen. Okay. Moving next. We talked about gamma, we talked about delta. We briefly talked about theta. The problem with theta is we actually haven't talked about it yet a lot in our lectures, because theta, as I think personally, is the most difficult Greek, because basically it's a kind of reflection of almost all other Greeks. So almost every single other Greek contributes by itself to theta. What we will talk about here is that the largest contribution to theta usually gives gamma. How does it work? We actually spent, I think, 2 lectures on that. Maybe I'm wrong, but technically we took a look at some binary tree, and that moves, say, up or down 1%. And we understood from that if you have some gamma, which is constant, that would be an assumption, but still it's a good one. And then we will generate some P&L from those moves. That will be equal to half of gamma multiplied by change in spot squared. Here is 1%, because of this is change in spot, right? So you generate that much profit. Again, it doesn't matter where it goes, up or down. On this position, if you have a gamma, you can generate this profit by delta hedging. Yeah. So technically, your expected value won't change if you don't delta hedge, but your volatility of P&L will be much lower if you delta hedge. But anyway, we are making this money. So if this position gives us profit, no matter where it goes, it makes sense to pay someone to buy this position, because no one will sell it to you for free. No one is selling a position that generates money for free. That's kind of, I would say, part of no arbitrage condition, or just like everyone likes money condition. So that's why it equals to theta in this particular case. So to clarify, if you are talking just about gamma effect on theta, it can be described like this. There are many more effects on theta, but this is the largest one, usually, in a real book, in a real portfolio. So what else can be seen is that the higher this change in spot, expected change in spot, the higher will be your P&L from gamma, right? So it can be thought about as market thinks that there will be some volatility for some period of time. Let's say 1 week. We are talking about 1 week. Market thinks that there will be some volatility, say the 1 week. And from this volatility, you can calculate how much theta will be generated by gamma alone, right? And if volatility will be higher, then the buyer of a gamma will generate more P&L than he pays by theta, and vice versa. If volatility will lower than market thought, the buyer of a gamma will make less profit than theta he will pay. So there is this well-known dependency between theta and gamma. That can be easily derived by binary tree, or if you happen to be learning some stochastical calculus, it can be also derived in 50 times more time, basically. What I want to remind you is, or not remind you, but new flavor here would be, let's say, yeah, easy. So in a real world, how it works actually, as you have seen, the gamma in the real world, it goes from this bell curve to this bell curve with time. So the less time there is to expiry, the higher will be the peak of the gamma. So the problem here is usually for a person, if there is a 1 day left, people do try to sell options that strike equals forward, because they do have a maximum gamma. So if everything else the same, so people do think, they do agree what is the expected volatility for the next day, like here for 1 week, like here for 1 week, yeah? So the price of this option will be maximum of all options for 1 day, because it has the highest gamma, and the gamma is highest contributor to theta. And guess what? For 1 day option, your theta, total theta to be exact, is equals your premium, because you'll lose all of it till the next day. If you are talking about theta as what you lose per day, so if you buy an option which is 1 day option for say $5,000 premium, guess like how much we will lose for 1 day. It's $5,000, because in a 1 day time, basically this option ceases to exist. It basically becomes a pumpkin at midnight, right? So whatever time it has for expiry. Why do they do this? Technically, it's not like a golden goose or whatever it is there is. So there are no free money here, but usually they do this to adjust the limit. Many venues, they do have, many banks for sure, they do have a limit for a theta per day that you can spend or you can get. Theta is part of a limit, a risk limit for sure, because some people, they do like to sell hell of a lot of stuff and just collect the theta because they think there is free money in the market. by just collecting theta, because theta pays you when time comes by, and when you're like a 30 years old, you sure know that time will come by, right? So the time will be spent, and you get your theta, whatever it takes. There is no other choice for you, and everything else is it can be or cannot be. Like, will this option pay you off or will not? It's a kind of stochastic part of this idea. So there is a common this common belief that collecting theta should be like a positive P&L long term, which if it would be true, it would be not that hard to notice, I would say. But so there is no free money here, sure, but people do trade those to lower the risk limits. And the case is that for one-day option, you usually expect it to be really cheap because most of one-day options, they are not at the strike, and you look at those like every day, and you think then one-day option should cost like some really small amount of money. But when it's at the strike, and especially second thought, as you can see, if you have some option and it's already one day, the lower your wall, the narrower this gamma profile. Why? In most cases, as we talked in the lectures, there is a really small difference between lowering the wall or decreasing the time. So if your time is the same, and let's say your time and wall is fixed somewhere, let's say 1 week and volatility is 10. So you're decreasing the time and becomes 3 days, or you're decreasing the walls, the wall volatility, and it becomes like a 5. For many things, the effect will be the same, because we are almost always thinking about what is the distribution of your asset at the end of the option, and the less the time, the more deterministic the distribution will be, and the less the volatility, the more deterministic the time will be. So the distribution will be, right? So if you think about it to the end, at the time of expiry, there is no no volatility and no nothing. Like, everything is already there. You know everything. Everything is determined. And guess what? If your volatility becomes 0, everything is determined even a week before, right? So effects are really close for many things. If you want to think about some effect, what will be if volatility goes lower, you can think about what will be if times goes by, and most probably you'll come up to the same conclusion. So if you go on lowering the volatility, the gamma will have higher profile. It will become 0 faster. Faster by moving from the strike. Yep. So if you're a one-day option on a low volatile market, your theta, your gamma may be really high, and if you have some risk limit on gamma, for example, you might want to check this. There was 2 or 3 times I came back to work at 11 p.m. So an hour before midnight, to just basically close some options, because at the end of the day there was some small move, but that move moved me to the strike of the option in some euro-dollar. So it just small volatility, but it shows you some huge gamma numbers, and it's much faster to basically trade this because it's super liquid. So cut it up in 10% than to educate your risk officer. So here's some new flavor. Okay.
Another question in the chat.
Oh, yeah. Thank you for actually telling me, because I'm kind of busy here. So if I if I sell 1 day call at the money and spot goes up 10% during 1 day, if spot goes up 10% during 1 day, it's already a start of a nice evening. Then I will lose 10% of current option value. The reason is delta becomes 1 and option P&L will behave like spot P&L. Question, is it really a strategy to sell 1 day call at maximum gamma in order to hope that it will manage to decrease option value to 0? So, if you're trading on some liquid market, and on this liquid market, there is no known cases of some big jumps or no expectation of those, I would assume you need to be really cautious about what you think is free there. Because at those markets, usually the only one free thing is a cheese in whatever that stuff that basically kills the mouse. So it can be the case for some markets who are liquid, but they once in a 4-3 years, they do have some 1 day blowouts. Like for example, Kazakh market was like that for some time. So it stays on the same place for like a year or two, or 4, and then it moves like 30% in a day. And guess what? I can bet you money someone would know about this before, not you. Those markets, yeah, there may be some big premium for this fat tail that might not be there for this year. So you will get your 1-year bonus with high probability before the bank at which you work will be destroyed. In these terms, technically, those situations are there. That's okay. But again, on normal markets, you need to have some sophisticated backtests for you to decide if something is overvalued or undervalued. That can be the case because sometimes market movers are some huge structured deals. So some guy was paid huge amount of money to hold some risk for a long period of time, say 2 years. And he wished to pay you some money to hold this risk for him, at least some part of it. Yeah. And those will have some positive expected value, right? That can happen. I can believe in that. Sometimes I was there, so yeah. It doesn't mean it will pay you. It will have positive expected value, which is much different from a positive P&L at the end of the year. Yeah, those are different things. So, first of all, if you sell 1 day call at the money and spot goes up 10% during 1 day, the question is, do you delta hedge it while it does or not? And the second question is, what was the implied volatility you traded that? If implied volatility was no delta hedge, you sell call and it moved 10%, yeah, you lose 10%. You won't lose 10% of current option value. You lose 10% multiplied by delta of this option, which is way higher than current option value. Again, it depends what was the implied volatility. Sometimes those options are traded at huge premiums. A good example would be president election day in US. Presidential election day in United States, especially when there are two really different types of people are at stake. So say two different policies, two different views on everything. This will make a huge impact on the markets, and no one will sell you this option with implying less than a 3-4% move, right? So at that case, your loss will be much less because you have a still option premium. Again, I don't see any reason to trade options with no delta hedge. If you want to trade spot, you have a spot basically. There is this, again, a small percentage of people who cannot trade spot and they obliged to trade only options. Yeah, maybe that's you, that's okay. But again, what implied volatility you used when you traded trade this option. If it was, I don't know, like 200, you might be actually a little bit down, but not that much. And again, spot goes up 10%. If you're talking about some crypto options, yeah.
Can I explain you the root cause of my question? Because every
Sure.
question I'm asking, I'm living in a bit different universe. So this is BTC, crypto options universe. And for BTC to go 10% for 4 hours easily, and you are sitting and you're operating in a different universe. This is a Forex universe. And of course, the euro dollar, it's understandable. So my point is about the implied volatility. What I'm observing while trading BTC options is that implied volatility spikes, they do occur. For instance, well, if 90% of time the implied volatility of BTC is 83%.
Okay.
And then
sorry to interrupt you. I understand.
Only 5. It's not so often causes that implied volatility gets outside the 85% for BTC. That's my point.
Sure. Question to you: what is the one-day implied volatility options? What is the one-day implied volatility on those options are?
As I have said, the probability of 95% that implied volatility will be the same 85%. Only when there is higher spot volatility, of course, the implied volatility may rise to 120%.
Sure. So what you're talking about here is the implied volatility is also much higher, right? In Eurodollar options, implied volatility is between, let's say, 6 and 11, 95% of time, right? So implied volatility for Bitcoin 30-40% looks low for one day. Again, one day is higher than 1 week or everything reaches above. Actually, for Bitcoin might be not true. Anyway, so first, I'm not a professional in Bitcoin options, but what I can tell you is that it actually doesn't matter what are the moves. It only matters what is the relationship between the realized volatility and implied volatility, right? So it can move not 10%, can move 100%. Doesn't matter. It doesn't tell you anything. Only what tells you something is what is the implied volatility and what is the realized volatility. Yeah, it moves a lot. Sure. Let's say you have Eurodollar. It moves 0.1%, right? Let's say I construct a contract that moves 100 times more than underlying. Can I do that? Yeah. It's basically just a leveraged forward. It will move 10% per day on Eurodollar. It's not a problem, right? So the problem here is what is your implied volatility and realized volatility, and you need to compare those two. And we touched these jumps, right? I can give you let's actually spend some time, 5 minutes on this. This is quite interesting. This will be a new flavor for you. Let's say let's assume this. You have some computer, and it gives you numbers. Those are distributed log normal. So they distributed basically log normal as a mutual market with volatility equals 10%. Say 16. I'm doing 16. It's just sometimes easier to think about 16 because it implies 1% per day standard deviation. So, but it takes every so with probability of 1,000, probability equals to 0.0001, it gives you some number that with volatility of say 160. Again, so what does how computer operates? It calculates this probability first. If it's 99.9 out of 1,000, it gives you some number which is distributed log normally with volatility 16. And if it's 1 out of 1,000, it gives you number with volatility 160. Okay. So the question now, you get a sample of, say, 100 numbers, 200 numbers. Question number one, what do you think if realized volatility of this sequence? Educated guess, right? Let's say it's not 1 out of 1,000. Let's say it's 1 out of 100. And you say you don't have 200, you have 30. So what is the volatility realized? Like assumption or something near. What do you think? You have, second question, you have 30 numbers that are generated like this. What do you think will be your estimate of realized volatility? And with what probability? So again, I'll repeat from the start this question. You have some computer that gives you numbers. This computer decides how to give you number, like next number, it will be infinite. And next number like this. First, it calculates some event, and with 99% probability, next number will be distributed as 16 volatility. And with 1% probability, next number will be distributed as 160% volatility. So basically, you can think about it as some, like a radio noise, and it's noisy, and then once in an hour or two, it just bumps you with a high sound, something like this, right? Question number one, what is, if you know how it calculates, if you know, what is the realized volatility? Approximately, at least. Question number two, what do you think you estimate volatility if you have 30 numbers only? You wrote down first 30 numbers from this computer, you went to your, whatever you calculate on those, and you calculate your realized volatility. Oh, make it even, sorry, I'm changing numbers all the time, but it doesn't matter. Make it 10. Make it 10. So who can answer me the first question? Who can answer me how to calculate the first question? Okay, at that point, on your place, I would think how to make more exercises on calculating volatility. Okay, easier question. Do you think the answer on the first question is higher or lower than 16? Do anyone hear me? Sorry, it just becomes a little bit strange now.
Yes, we hear you.
Oh,
Yeah, we hear
okay.
you. Yeah, we hear you, but I was just trying to answer your question. Yeah.
Yeah. So, okay. If you don't know the answer to the question, let's think something easier, right?
Yeah, you can explain, and if possible, show us the diagrams and draw.
Let's think this computer just gives you a number with volatility 16, nothing else. Realized volatility will be 16. It's quite easy, right? It gives you something volatility 16. If you collect like billions and billions of those numbers and calculate realized volatility almost surely it will be 16. Okay. What if it gives you one number with volatility 16 and other with volatility, say 0? So the same number every time. So it's like a something random and a 5. Random, 5. Random, 5. What do you think will be realized volatility of this? It's 50-50. So it gives you one number with volatility 16 and one number with volatility 0. What do you think?
Something in between?
Sure. It's a good enough answer, actually.
Mhm.
It's not like a mathematical class, something in between. Sure.
Mhm.
How do you think we will be closer to 0 or to 16? What do you think?
The realized volatility or the volatility?
Realized volatility.
We have to calculate the realized volatility just to come up with
Yeah. Okay. So let's not spend our time on this. So think about it like as if it's 50-50. Do you understand the answer there? If not, just try to do it in Excel or whatever, like calculate it by hand. Calculate it by hand, really. And think like, how can I calculate it by formula? Just move to the formula, then change 50-50 chance in formula by 0.1, and you'll have your answer. There is nothing like really difficult here.
Yeah.
Let's get back to our question. So how does this looks like? Let's say you calculated this and you get, say, 25. Let's say, for example, yeah. So how do this looks like? Oh, it looks like this. So you have some noise. Then out of 1,000, you have this. Then you have some noise, and this. That's how it looks like, right?
Yeah.
So, and we can see the probability is 1 out of 100, and our sample is 10. That means that there is a probability equals 10 divided by 100. So 1/10 or 10%, that we will in our 10 numbers, we will catch this huge outlier, right? Think about it again. Something gives you outlier, 1 out of 100, and you have only 10 numbers to catch. With what probability you'll catch this outlier? It's about 1/10, right? So with probability of 1/10, you catch this outlier. And if you don't catch it, so you have, if you don't catch it, you will estimate your realized volatility only based on these numbers, because you haven't seen this huge outlier, right? So with probability of 10%, you have 16. Oh, sorry. My bad, of course. With probability of 90%, so with probability of 90%, you won't catch this outlier again, this one, yeah? And you will see only those numbers. And we do know that if there are only those numbers with volatility 16, you will estimate the realized volatility as 16. So with probability of 90%, you estimate your volatility as 16. And with probability of 10%, what you will get is 9 numbers that are fine and 1 outlier. And you would think the probability of this outlier is not 1 out of 100, that is really is. You'll think that this probability is 1 out of 10, which is 10 times higher. So if we calculate in here 25, you'll calculate here something like, say, some 75. You get just 10 numbers. And with probability of 10%, one of them will be like 10, with probability of 10%, at least one of them, will be 160 volatility. And you would think, whoa, it might be 1 out of 10 that I'll get this huge outlier. and you will estimate your realized volatility as 75. What that tells us, actually, why this example is here, what we're talking here about. We have some world when with 1% probability, it gets huge shock. But we only can collect some limited amount of information about this world, less than frequency of this shock. And with really high probability, this 90%, we will underestimate volatility of this world. And with small probability, we will significantly overestimate the volatility of this world. So your volatility estimations are has some margin of error, and those are highly dependent on the amount of information you have, right? We actually saw something like 2020 event, and we were like, the whole world was shocked, like. But technically, we had events like these every 100 years or so, right? If you open Wikipedia, you can see that there was a year without a summer. So there was a year when summer didn't actually, was no summer on the North Hemisphere, I suppose, because some huge volcano erupted and almost all summer, the whole sky was covered in ash. So sunlight couldn't get through, and prices on food went up 10 times. If you were to be 12 years old at that year, you would think that in your lifetime you would see it again, because you saw it in your lifetime when you only was 12. And at the time you were 25 or 35, you would think you would wait for it, right? Those were like these 10%. Sorry, I'm pointing with my finger, you don't see it. Like this 10% case. We were living in a world without big wars, without big pandemics before 2020, and we thought that everything is being a nice, looks like not. So it highly depends on the amount of time you get in your backtest, right? If you get a lot of time, you would see that some other species were roaming this planet, like dinosaurs, yeah? And they'll go just got demolished fully, like not a single one alive now. So that's how big outlier you can get if you're going like millions of years before, right? So it just depends on some statistical things. So I would assume that if you do a huge run on Bitcoin and some other assets you think are alike, the picture will be clear if it's overvalued or not. Again, I'm not saying it cannot be overvalued. Everything is arbitrage free and so on and so on and so on. There are some huge deals that can move this equilibrium. There are some periods of times when some risk events just don't come by, and it's just your full decision to think if you're lucky or you guessed right and so on. But again, what I can tell you is that first, it doesn't matter what is your realized volatility. Can be 10, can be per day, or can be 100. It depends on a relationship between your realized volatility and implied volatility. So it makes no sense to think to look at one and don't look at another. And the second is like, what are the parameters of your backtest that you are doing these calculations on? Is it a 3-year or a 10 years? Do you account for some other assets that can be looked like? So it's like technically it's a long talk, but yeah, those 2 points I would say are the main. Okay. Let's move further, actually. What do we have next? Gamma we talked about. We haven't talked about Vega. What we talked about Vega? We on lectures, we talked that it looks like a bell-shaped curve. And the higher the time to expiry, the higher this curve. So there is really little Vega in 1 day, 1 week options, and there are a lot of Vega in long dated options. It's the first time I think you need it might be good for you to think about rates. A good question would be, for example, it's basically for advanced people only. I mean, like people who are who know a little bit deeper those topics. Let's say a question: what do you think is the Vega of a 1,000 years option? Should it be really, really huge, like in a book, or what is happening there? So you might think about that. Anyway, so big picture, what we talked here about, we actually have about 10 minutes, right? So what we talked here about is that there are the Vega can be calculated for different terms. So we have, say, 500 options. Then you can distribute them by time. So do some table, say 1 week, 1 month, 3 months, 1 year, for example. Yeah, and calculate Vega for every single term here. Sorry, Vega. Yeah. That way you'll get your Vega distribution by time. That really helps you because some volatilities do tend to move more than others. Some short volatilities do tend to move more than the, say, 1 year or 2 year volatilities, because we don't know much about 2 year or 3 years time. So we just assume based on some previous records we do have, and those are changing not that much because it's some average metrics. So for example, even if you have 1 day really volatile, you still need to account all those days that were not volatile. So it will smooth out this effect for long-term options and so on. And for 1 week option, even single news can change drastically volatility. For example, if you're living in some, you're trading some currency that is currency of some oil export heavily country, or oil import heavily country like Turkey, for example, right? Okay, in Turkey you don't have any demand for more volatility, but say oil, or some country that exports oil a lot, Mexico, for example, right? So in 1 week time, oil prices can change due to some events. If some people want to do some action in Middle East, for example, right? This will generate a lot of volatility in your base asset, which would be the FX. And for 1 week, you'll see a huge jump, most probably in volatility. Will it increase 3 years volatility? Sure, but much less, much less. So it makes sense to take a look at volatility by terms. If you want to take a look at one number, people do like to look at one number, like a GDP of a country, right? So you might want to do something that is called weighted Vega. Where basically you take some Vega as a 1, so as a base. Say, for example, usually it's a 3 month or 1 year. Say, for example, 1 year Vega will be equal to 1 year Vega. And everything else which is below it will be with some multiplier, which is higher than 1, and everything above it with multiplier lower than 1. Thus, you can see something like a principal component analysis in Vega, or in easy terms, some basically weighted Vega, like how much of a 1 year Vega should I trade to Vega neutral disposition. Yep, you don't need to know much about principal component analysis to do this. You can just do it in Excel by calculating the realized volatility of every single of those terms. Okay, so we talked about weighted Vega as a nice way to look at Vega as a one number. Again, it's just it's not the best metric you can have. Every time some people do collide many numbers in one, that makes some cases not really good. Like again, like a GDP. So if in Italy someone made say 3 purses, $100 each. It's 3 purses people will use for 20 years, and someone made in New York a haircut for $300, the same $300, right? So sometimes it doesn't look intuitively right. So you might wanna look at something smooth and liquid as a weighted Vega, and something like emerging markets or markets worse than emerging with more precise, right? So basically as weighted Vega and some metrics of distribution of this weighted Vega, like how much weighted Vega corresponds to basically, for example, weighted Vega can be $1,000 if you have a 1 year Vega, $1,000, or if you have $10 like $20 in 1 week and $5,000 in 6 years, something like this. Not that much, but I mean, like say $1,200 in 6 years, right? And those are totally different positions. We know that. So you might want to get some metrics for distribution of this Vega and look at this also for some emerging markets or something worse than emerging markets. And if it's go above some level, you would just take a look at it and decrease the outlier or whatever is there for you. Okay, we won't stop much on a Vega here because of time. What we looked after that? We looked after that on Vanna and Volga. I think we looked at Volga. Not that sure. Anyway, so we actually took a look at volatility surface construction. That's a huge chunk. So we know how to construct volatility surface by strike or by delta. And by strike, it's all basically looks like a dependency of volatility by strike. Nothing can be said about it more. And by delta, it looks like at the money delta neutral usually. 25 delta call, 10 delta call, and 25 delta put, and 10 delta put. You can read about this in the book about that calls like I think derivatives trader school. So there are a lot of small details we won't cover here today. We talked about on the lectures, but big picture, we know how to construct it. We do know that there are simple products, like there are really popular products that are traded on the market, which are at the money delta neutral settle and risk reversal and fly. This is used to hedge your Vega. This is used to hedge your Vanna or Riega. Riega is, I am not sure we covered this in the lectures, but this is like a really close parameter. Basically, what is Riega? When you change your risk reversal, it changes the P&L of your portfolio. So this is derivative of portfolio value to change in risk reversal. Technically, it's a derivative of option value to risk reversal. That's the same. Fly is used to hedge your Volga position or your Sega. You can guess that Sega is a derivative of your option price to Fly. Hence, the Fly used to hedge it. And Volga is basically derivative of price by volatility 2 times. So second derivative of price by volatility. What was here interesting, actually we covered some special cases on the lectures. For example, if you have one big option, you don't need to hedge all 3, like Vega, Vanna, and Volga. You just need to hedge this option. But usually people in the real world, they do tend to look at those Greeks we talked about, plus theta. So when you have some option portfolio that is big, what I would call big, something more than 30 options, well distributed, it's a really good idea. Even like actually 10 good distributed options is already a good idea to look at with those Greeks. So they don't look at every single option. They look at Greeks of those options and hedge those, because Greeks are derivative of your P&L by some market metrics, be it or spot price or volatility or say some shape of a curve, volatility curve, for example, Riega and Sega, yeah. And if those are close to 0, you might be almost sure that your P&L volatility will be low. If it's not, then it means there are some special situations involved. Those can be if you have some tricky volatility surface, for example, semi-packed currencies or some big event coming up in the next day or 2, like elections or something else. Or there'll be a huge disproportion in options. So for example, you have one option that is responsible for 90% of your, like 80% of your P&L. Then it might be not that well hedged with all those Greeks, because it's not like it has some other Greeks that are also making a big contribution. For example, Delta Bleed we talked about. For example, some sensitivity to your volatility surface construction methods. It can be, if your volatility surface construction methods are not very good, I would say, then there can be a couple of weeks of a huge theta and a couple of weeks of a small theta, because its smoothness, it looks like what I'm showing here like this. So it will go on a steep part on the curve, and then it will go on the flat part of the curve. And this will create for you some weeks of improper theta. But usually on a nice distributed portfolio, for example, if you're algo trading on exchange, or if you're sitting in a bank with some small clients trading a lot, you won't see those effects. Those are good times for you. That's great. And traders do tend to look at Greeks. They don't care about if new deal comes up and someone asks you to price some call or put, you don't care. I mean, like if it's put or call, why would you? You delta hedge it right away, and after that, it's indistinguishable from basically call is indistinguishable from a put after delta hedge. No one cares. So some sales who do know how to present those trades to a trader, they don't even mention if it's a call or a put. They just ask a strike at time and some approximate notional if it's larger than something people would care about. What else can be said here is there are lots of small details left. Again, like how you construct your volatility surface. Do you have some exotic options? And many more. And it's always not a single volatility surface you do trade, it's a couple. So it's a good question if you do have correlation between those volatility surfaces move and so on. You almost always do, because they all of them almost are against one currency, which is dollar. So if you're trading, say, for example, dollar Turkey and dollar Mex, would you have some correlations involved? Yeah, sure. First of all, one of them is oil exports, the other one is oil import, and they're both against dollar. So every time the dollar goes up against everything, those will move. and so those effects should be accounted for also. But if we're talking about some brief overview, that would be about it. I did more focus on some older themes like a delta, gamma, and stuff, and less focus on what was at the end, because it was not that far away from now. So if you have some questions, you can ask those. Okay, there is a question in questions actually in the chat. Market makers change their quote in real time with reaction on relative volatility. Yeah, market makers, they change their quotes depending on many things. Basically, it's difficult to invent some things they don't change quotes on. That's true. One of them, it would be relative volatility for sure. If you're talking about market makers and options, if you're talking about market makers and underlying, yeah, you're also right. But we will have source for self-study. Yeah, I gave actually 4 books as home reading at lecture number 2 or 3. Those books are great. You can read every single one of them. There is no hull. Yeah, there is no hull among them. So FX options and crypto options perpetuals appear to share several similarities. My understanding is that some concepts used in crypto perpetual options markets are influenced by FX derivatives. Yep. Could you recommend any books that cover FX options and crypto perpetuals, or explain how the two markets are connected? So again, if FX derivatives were there way before crypto, and so I'm pretty sure that everything there is influenced by FX derivatives. You can read any of those 4 books I recommended for home reading. If you don't have those, just write in the chat. Someone will post them again. Don't think that, like, of course, there are some details that take apart usual markets and crypto markets. But first, those I'm not familiar with because I'm not a crypto trader by any means. The second, I would think that most probably it's a good idea to learn about conventional markets before, because they are really well developed. And I cannot imagine anything that can be in crypto markets that was not there before in conventional markets. So most probably it will be something that is really, really similar to what is it is there in conventional markets. Yeah.
I have a question, may I ask?
Sure, that's why I'm here.
Yeah. It's kind of more practical one. So you mentioned your experience in Kazakh market. So I'm curious if any instruments are available for retail investors to hedge the USD tenge exposure. So, like for instance, if you want to have some strategies for like a carry trader or invest just in some tenge instruments. I mean, probably for banks, you may have something like an FX options, but I'm curious if you may know anything for retail investors. Thank you.
Yeah, so if I'm understood, are there any instruments for hedging something with tenge? So when I started, say like 20 years ago, dollar tenge was a huge options market. Yeah, it was basically a gamble field for options traders because, as I said, it stayed on the same place before it just blow up. So it's an interesting concept. You see, when you think about details, options traders, they do get their bonus once in a year, usually. So what you need to do is to input this into utility function of options trader. For example, let's say you have a place with that doesn't know about any limits. It just tells you, go on, trade something, and we'll pay you 10% of what you made. That's nice. You just find some currency pair that is pegged. Say, for example, dollar SAR, dollar versus Saudi Arabia Rial. it is pegged more than most of you live on this world. So the probability of this currency to be unpegged, I would say, can be sold at 3%. This probability can be sold at 3%. And there are people who are buying it at, say, 0.5% all the time. There is a market, it's really narrow. And what you can do in this case particular, you can dose this market and sell every option they're willing to buy. You just sell $5 trillion of those options. And with probability of let's say a real probability of 3%, that next year this peg will be broken and SAR will go to infinity. Let's say. Then with probability of 97%, this year you'll make a lot of money because your options are out of the money that you sold and you collect all the premium, right? With probability of 97%, you'll get a lot of money as a personal bonus. That sounds nice. So with probability of 97%, you can do that next year, and next year. And yeah, in 30 years' time, something most probably will blow up with this probability, right? And you lose a lot of money for the firm. Maybe the amount of money will be more than from a current valuation. It's actually not that probable, actually, because of the CSA and stuff. But let's not talk about like small details like this. In this case, let's say it will be on 10th year of your career. So 10 years straight, you collected millions of dollars as your bonus. You're sitting there in your $500,000 watch at the table and you see a news that something blows up and Central Bank of Saudi Arabia just leaves the market to itself, and dollar versus Saudi Arabia goes to infinity and it's bid on. Then you stay up at your place, you put on your hat, you sit in your Ferrari and never come back. That's it. Basically, you say, okay, now you can fire me. I'm ready. That's it. So what that means, some markets, even in those times, but in those times especially, they like to sell something that won't blow up this year. because this year, because you collect your bonus. That can be a really big, it's basically a life-changing bonus, right? For many people. And those options were traded in huge amounts on dollar tenge. In year 2014, it blown up, I think in 11 or 12. I don't remember the actual year, but it blown up. People who did sell those options, they actually had a really good hedge. So if you sold, say, $5 billion options on dollar tenge in your bank somehow, there is only one hedge possible for you. This hedge would be offered to another bank on a higher position as a head of a lot of people, because you're smart. You're making money several years out of thin air. You're basically sitting on your chair, clicking a keyboard, and millions of dollars appear on the screen, right? You sound like a decent person who deserves a much better position in another bank. So stuff blown up. People just change places. And after that, in 2014, I personally asked a person for not that big one option to price on dollar tenge. And after maybe 10th time I asked him to do it, I was fully, I understood like with 100% probability, no one even will give you a price for that. No one even will give you a price. Like you can ask for a price that you won't trade on, it calls a level. So you promise not to trade on this price. Even if you then say I'll trade, it won't count. And that will never happen again. But I mean, you're asking for a level. So what basically you're asking a person where this person thinks it should be. No one will even do this. And we actually did several attempts to recreate those surfaces. So basically to market make those currencies. I think we traded one or two. So the problem there is that there is only one side. Everyone's everyone want to buy a DOT and get call. That's it. No one cares about anything else. So everyone wants to buy volatility. And there are tips and tricks how to make this market. So you can do some dual currency deposits in this market that people will sell you basically gamma, you will sell Vega against it, and you will be kind of in a nice spot to be. But that never happened actually. And as far as I know now, there is not a significant market there in DOT and GEA options still. So still up to this day. I think it will take some time for DOT and GEA to develop. I would think that would be a nice market to trade. It won't be huge, never. It won't be something like a nice place to build your career on, but most probably there will be a premium for people who are selling volatility. So if you sell volatility every year, you'll get some positive P&L until again blows up, and it blows up every several years. So it would be a nice market, but it's not there. As I know, maybe there are something trades on somewhere in some thousands of dollars, but that's not a market. If it doesn't trade at least at $50 million per day, basically something like I don't know what it is. It's basically nothing. So yeah, that's your answer. It's an instant market. It was there until 2012, I suppose. Until the blowout that happened in 2012, and after that, nothing traded there, and there was only one side always. And again, there is this effect. You don't want to be on the market where someone knows something before you. And I would say with high probability, this is market like this. So if there will be a blowout, I can bet you money some big people in Kazakh, they won't lose on it. They'll make money, and you'll be among those who lose, even if you're a big bank. So it's the other problem.
So nobody really hedge on this market?
Options, there are forwards, swaps, there are futures. They trade a lot, but I don't think there is an options market as of now. Yes.
Okay, thank you.
Yeah. Okay, let's do maybe some other last question. Why not? I actually asked several questions on this lecture. You might write it down and write it in the chat later. And I'm kind of concerned no one answered me on this question, like what is the realized volatility for this time series. If you trade options, you do need to understand how to calculate realized volatility. It's really good for you to read a little bit more about it, like what is the estimation, what is a biased estimation, like what are the metrics of estimations. Yeah, for realized volatility, you choose always either you calculate a bias estimate, but really, but more precise, or less precise but not biased. And there is a fundamental issue there. You can read about it. It's not like life-changing or anything, but I mean, I would say you need to know how to calculate realized volatility of 5 numbers. Sure. Yeah, I mean, it's not like some high-end math here, right? Okay, any other questions?
Yeah, so Anton, thank you. So I just put a question on the chat. If you can read, please.
Yeah. Could you please write down the names of the books you recommend in the lectures? It's in the chat. Let's say this is the last question. I'll find it now and I'll post it here while I'm wrapping up my screen share and giving words to Andrew. Okay. So I won't take time for the next person. Yeah. Thank you, everyone.